Hello everyone. Welcome back to our channel. Today we'll be diving deep into IFRS 13, Fair Value Measurement. This standard plays a crucial role in financial reporting, providing guidelines to measure and disclose fair value in a consistent and transparent manner. By the end of this video, you'll understand the core concepts, its applications, and how to tackle challenges in fair value measurement. So let's get started. So what is IFRS 13? IFRS 13 focuses on defining fair value and setting out a framework for its measurement. It applies to assets, liabilities, and equity instruments whenever fair value is required or permitted under other IFRS standards. The primary objectives of IFRS 13 are to provide a precise definition of fair value, to create a single unified framework for measuring fair value across all IFRS standards, to enhance transparency through robust disclosures about fair value measurement. IFRS 13 provides guidance on how to measure fair value, while the where, when, and what aspects of fair value measurement are determined by the specific requirements of other IFRS standards. The scope of IFRS 13 includes standards like property, plant, and equipment (PPE), business combinations, impairment of assets. However, certain standards are excluded, such as share-based payments, leases, inventories. Before starting, what is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value is based on market participant assumptions, not the entity's perspective. It focuses on the exit price, the amount to sell an asset or transfer a liability. Fair value is not based on settlement amounts but instead reflects a price determined in an active, orderly market. To measure fair value, entities must determine the four things that are unit of account, non-financial assets, principal or most advantageous market, and valuation technique. So let's start by the unit of account. Is the measurement for an individual asset or liability? Or is it for a group of assets, liabilities, or a mix of both? For instance, measuring a controlling interest in a company involves a group of assets and liabilities. Next, the principal or most advantageous market. The principal market is the one with the highest volume or activity. If no principal market exists, the most advantageous market, where the best price can be achieved, is used. Highest and best use for non-financial assets. Fair value should consider the most advantageous use of the asset. It must be physically possible, legally permissible, and financially feasible. For liabilities and equity instruments, the process involves using quoted prices if available, leveraging identical items held as assets by other parties, applying valuation techniques if no market data exists. Let's move to valuation technique. Valuation should align with the fair value hierarchy, ensuring data reliability. 3 approaches are outlined for measuring fair value. 1. Market approach, which uses prices and other market data from transactions involving identical or similar assets and liabilities. Example, real estate or publicly traded securities. 2. Cost approach, which focuses on the current replacement cost of an asset. Example, determining the cost to replace a customized machine in its current condition. 3. Income approach, which estimates the present value of future cash flows expected from the asset or liability. Example, valuing a business based on its projected earnings. When selecting a technique, entities should use the method most appropriate for the circumstances, prioritize observable data, and minimize reliance on subjective inputs. IFRS 13 categorizes inputs into a 3-level hierarchy to ensure transparency. Level 1. Quoted prices in active markets for identical assets or liabilities. Level 2. Observable inputs for similar assets, such as quoted prices in less active markets. Level 3. Unobservable inputs based on assumptions, such as financial forecasts. For example, valuing land typically falls under Level 2 if market data exists. However, valuing a specialized asset might require Level 3 inputs, such as cash flow projections. Let's walk through an example. A company purchased a machine 2 years ago for $50,000 and spent an additional $10,000 on customizations. To determine its fair value today, the market approach isn't applicable since no comparable market data exists. The income approach involves estimating future cash inflows, but this introduces significant uncertainty. The cost approach estimates the current replacement cost at $40,000, considering its condition and wear and tear. Although the income approach gives the higher valuation, but in this scenario the cost approach is the most reliable, as it involves fewer assumptions. At last, disclosure requirements under IFRS 13. Transparency is critical. Disclosures must include the fair value measurement at the reporting date, the valuation techniques and inputs used, the hierarchy level of inputs. For recurring fair value measurements using Level 3 inputs includes effects on profit or loss or other comprehensive income. The reasons for non-recurring fair value measurements. These disclosures help stakeholders understand the methods and assumptions underlying fair value estimates. And that's an in-depth look at IFRS 13, fair value measurement. By providing clear guidance and robust disclosure requirements, this standard ensures fairness and transparency in financial reporting. If you found this video informative, please give it a thumbs up, subscribe to our channel, and hit the bell icon to stay updated on accounting and finance insights. Thank you for watching, and we'll see you in the next video.